welcome to the Deep Dive. You sent us a fascinating collection of information on Mullen Automotive. Everything from detailed financial breakdowns and market share analyses to reviews of their vehicle lineup and assessments of their technological bets. Our goal today is straightforward: to cut through the noise and figure out what all this data really tells us about Mullen's potential to grow.
Exactly. You're tasking us with a comprehensive analysis looking at Mullen from, all angles. We need to understand their current standing and, crucially, decipher what the data suggests about their trajectory moving forward.
For those of you joining us for the first time, Mullen Automotive is an electric vehicle manufacturer based in Southern California, specifically in Brea. They've been around since 2014 and are now primarily focused on the commercial EV market, although they still have some consumer models in the pipeline.
Right.
Their operations are structured under the Bollinger and Mullen commercial divisions, and they currently employ around 388 people.
And the central question you posed, the one we're really going to dig into for you, is understanding that growth trajectory slope of 0.45 that's emerged from some of the analysis. What does that number truly signify when we consider Mullen's future prospects? That's the core of our deep dive today.
Okay, let's unpack this by looking at the financial side of things first. Now, there's some undeniably positive news right off the bat. In the first quarter of 2025, Mullen achieved a record quarterly revenue of $3.18 million. What makes this really stand out is that it's a massive 189% jump compared to their total revenue for the entire 2024 fiscal year, which was just $1.1 million.
Wow.
Looking at the 12 months leading up to Q1 2025, their total revenue is $4.01 million. That kind of growth sounds pretty encouraging, doesn't it?
It does look encouraging on the surface, and that level of growth in a relatively short period is certainly worth noting. However, the key insight here is that this revenue, while growing impressively, is currently nowhere near enough to offset their staggering cash burn. This raises immediate questions about their operational runway and whether this growth is sustainable without significant cost reductions or new funding.
You're referring to their cash reserves, which is where the picture becomes much more concerning, doesn't it? Their cash reserves plummeted from $155.7 million in September 2023 to a mere $10.7 million by September 2024.
Oof.
And on top of that, they've accumulated a net loss of $561 million, with a monthly cash burn of around $12.8 million as of the second quarter of 2024. It's a stark contrast to that revenue growth we just talked about.
Absolutely. That rate of cash expenditure against those rapidly diminishing reserves is a critical factor for their long-term viability. While the revenue increase is a positive sign, the magnitude of the losses and the speed at which they're using cash paints a precarious picture.
They have announced some efforts to cut costs, though. There's mention of $13 million in measures, including staff reductions and consolidating their facilities. Every little bit helps, right? Or does it really move the needle against that massive monthly burn?
Well, while $13 million in cuts sounds like a step in the right direction and demonstrates, an awareness of the financial pressures, let's put that into perspective against their $12.8 million monthly burn.
Right.
While it will provide some temporary relief, the crucial question is whether these cuts are deep enough and fast enough to significantly extend their operational runway and pave the way to sustainable profitability.
And then there's the stock performance. MULN on the NASDAQ is currently trading around $0.11. Their market capitalization is just over $375,000.
Tiny.
But the 52-week price range is frankly astonishing, from a low of $0.095 all the way up to nearly $47,100. That massive spike must be connected to the 1-for-60 reverse stock split they implemented in February 2025, wouldn't you say?
Precisely. Reverse stock splits are often a mechanism for companies to artificially boost their stock price to meet exchange listing requirements, but they don't inherently change the underlying value of the company. That incredible volatility within the 52-week range really underscores the speculative nature surrounding this stock, doesn't it? It's a stark reminder of the high-stakes environment they're operating in.
Speaking of listing requirements, they're facing a NASDAQ compliance issue with a deadline of August 25th, 2025. So it sounds like they're under pressure to get their stock price back above the minimum threshold to avoid potential delisting.
That's correct. Failure to regain compliance could indeed lead to delisting, which would likely have further negative repercussions on investor confidence in their ability to raise capital. It all circles back to that challenging financial landscape we've been discussing.
Okay, let's pivot now and look at where Mullen fits into the broader electric vehicle market. The data indicates they currently hold a relatively small market share, around 2.53% within their specific commercial vehicle segment.
Specific segment.
Their presence in the overall EV market is even more minimal. That seems like a significant hurdle to overcome.
It is a significant hurdle. When you consider the dominant players in the EV arena, the Teslas, Chevrolets, Fords, Nissans, and the global giant BYD Mullen is operating in a highly competitive space.
Yeah.
Even within the commercial EV sector, they face established competitors like Orange EV and VIA Motors, not to mention Bollinger Motors, which interestingly is now part of Mullen,
Right, which is interesting.
instantly giving them a broader portfolio in the higher commercial vehicle classes, which we'll examine in more detail shortly.
Right, the acquisition of Bollinger, that's a strategic move to expand their reach in the commercial market. And it appears they've made a deliberate shift in focus towards these commercial EVs, specifically those Class 1, think smaller cargo vans, up to Class 3 heavier duty trucks used for regional deliveries.
Yep.
They seem to be moving away from their broader consumer vehicle ambitions, at least for now. In such a crowded market, does this focused approach make sense?
It's a pragmatic strategy, in my assessment. The consumer EV market is incredibly saturated and demands substantial capital investment. By concentrating on commercial EVs, they can target more specific needs, such as last-mile delivery and regional fleets, where the competitive intensity might be somewhat lower, at least in the immediate future.
And they are actively working on expanding their distribution network, which is crucial for getting their vehicles into the hands of customers. They've now got 7 dealers on board, including well-known names like Pay Kenworth and Pritchard EV. That suggests they're making progress in reaching potential commercial buyers.
Absolutely. A robust dealer network is vital for generating sales, providing essential service and maintenance, and, building trust and long-term relationships with fleet operators. Partnering with established players in the commercial vehicle sector lends them valuable credibility and expands their market reach.
What's also striking is the immense size and anticipated growth of the U.S. commercial electric vehicle market. Projections suggest it will surge from nearly $14 billion in 2023 to almost $56 billion by 2029.
Huge growth.
And the broader U.S. EV market is already substantial, estimated to be between $120 billion and over $200 billion in 2024. Even the commercial EV market alone is expected to see significant expansion just between 2024 and 2025. So there's a huge potential market out there.
There is indeed significant potential, and that represents a key opportunity for Mullen. However, the critical question remains, can they capture a large enough share of this rapidly growing market to achieve sustainable profitability and long-term growth, especially given the fierce competition and their current relatively small footprint?
Let's delve into what Mullen is actually offering in terms of vehicles. Their commercial lineup appears quite diverse. They have the Mullen 1, which is a Class 1 electric cargo van with a respectable range and payload capacity, and importantly, it's in production. Then there's the Mullen 3HC, a Class 3 low cab forward electric truck, also in production with a starting price around $68,500. And of course, the Bollinger B4, a Class 4 commercial electric truck, positioned at a higher price point of nearly $160,000, but also currently in production.
We should also mention the Mullen IGU, which is a Class 1 urban delivery EV. It features a smaller battery and a lower top speed, making it specifically designed for those, short distance intercity delivery needs. That model is also listed as being in production.
Okay. And then there's the Power UP, which is a particularly innovative concept, a Class 3 mobile charging truck. It's equipped with a significant battery capacity and both DC fast chargers and level 2 charging options. This is expected to launch in the fourth quarter of 2024. That could be a really unique value proposition for fleet operators.
It certainly addresses a major pain point in EV adoption, which is the availability of charging infrastructure, particularly for commercial fleets operating across various locations. If Mullen can successfully bring the Power UP to market and execute the concept effectively, it has the potential to be a significant differentiator for them.
Now, they haven't entirely abandoned the consumer EV market. They still have the Mullen 5, 5RS, and GT models under development. The 5RS, with a claimed 0-60 time of under 2 seconds, sounds like a performance beast.
Yeah, quite the claim.
However, as the reports emphasize, their primary strategic focus has clearly shifted towards those commercial vehicles.
Yes, those consumer-focused models appear to be a secondary priority at this stage. The main thrust of their efforts is undoubtedly in the commercial EV space, and that aligns with a more pragmatic approach given their current resource constraints and the immediate opportunities within that market segment.
Let's move on to the crucial area of technology. Mullen has been generating a lot of buzz around their solid-state polymer battery technology. They claim it offers substantial advantages in terms of energy density, and back in 2022, they even reported test results suggesting a potential range of over 600 miles. If this technology can be successfully commercialized, it could be a real game changer.
It certainly holds considerable promise. Solid-state batteries are widely regarded as the next generation of battery technology for electric vehicles, potentially offering significant improvements in safety, energy density, and charging speeds. However, it's important to underscore the word development. Scaling up the production of solid-state batteries to a commercially viable level is a significant technological and manufacturing challenge that numerous companies are still working to overcome. The successful commercialization of this technology by Mullen, if it happens, could indeed be a significant catalyst for future growth, offering a compelling advantage over competitors in range and charging times.
They also have this Power Boost battery pack exchange program in the works. It's an interesting model allowing for quick battery swaps instead of waiting for a recharge.
It's a concept that could be particularly attractive to commercial fleets, where minimizing downtime is paramount. However, it also necessitates a significant investment in infrastructure and the standardization of battery pack designs.
In terms of their manufacturing capabilities, they have several facilities, including those in Tunica, Mishawaka, and Fullerton. The Fullerton plant is dedicated to battery production, with a reported annual capacity of 1 GWh across 4 production lines. And there are plans for a substantial expansion of their AM, Advanced Manufacturing and Engineering facility. So they are investing in building up their production capacity.
They are indeed laying the groundwork for increased production volumes, which is essential if they aim to scale their operations to meet potential demand. The Tunica facility is key for their commercial vehicle production, and the battery plant in Fullerton represents a move towards greater vertical integration of their supply chain,
Right.
which can offer benefits in the long run in terms of cost control and potentially technological differentiation.
Their estimated annual investment in research and development is in the range of $20 to $50 million, which is noted as being less than that of the larger players in the industry. That's probably not surprising given their current size and financial situation.
Absolutely. Research and development in the automotive sector, especially in the rapidly evolving field of electric vehicles, is an incredibly expensive undertaking. Their classification as a Tier 3 automotive technology spender, indicating an annual R&D budget between $10 million and $100 million, puts their investment in perspective against the much larger expenditures of industry leaders.
Yeah.
This suggests they are likely focusing their R&D efforts on core technologies directly related to their current product roadmap.
And it seems they're adopting a quite pragmatic approach to their technology strategy, focusing on those essential vehicle technologies rather than heavily investing in areas like advanced software or autonomous driving systems, at least for the time being.
Makes sense.
They are, however, engaging in strategic technology partnerships for specific needs like over-the-air updates, performance enhancements, charging infrastructure, even a partnership related to generating water from air, and some engineering support. It looks like they're strategically leveraging external expertise where it makes the most sense for the current priorities.
That's a smart and resource-efficient approach for a company with limited capital. Strategic collaborations can provide access to established technologies and specialized expertise without the need for extensive and costly in-house development, allowing them to focus their resources on their core vehicle production and battery technology efforts.
All right, let's circle back to that growth trajectory analysis and the resulting slope of 0.5. The reports detail that this was calculated based on 4 weighted dimensions: financial performance, which carried the highest weight at 40%,
Right, the big one.
market position at 25%, their product portfolio at 20%, and technology and innovation at 15%.
Yes, and within each of those dimensions, a range of specific factors were evaluated and assigned scores based on the available data. For example, within financial performance, they would have looked at metrics such as revenue growth rate, current cash reserves, profitability or lack thereof, and the effectiveness of their cost management efforts. The 40% weight on financial performance reflects the fundamental importance of having enough money to operate and grow.
Makes sense.
Without a solid financial foundation, even a great product or market position can falter.
So, what were the positive factors that contributed to that upward slope? Significant revenue growth was clearly a major contributor.
Definitely.
Their strategic shift towards commercial EVs was also viewed positively, as was the expansion of their product offerings through acquisitions like Bollinger. The fact that they are now actively producing and delivering vehicles with serial production of the B4 starting in September 2024 and the initial deliveries of Class 3 trucks to Randy Marion Automotive Group demonstrates tangible progress.
Hitting milestones.
And of course, those cost-cutting initiatives we discussed earlier also played a role. They even reported selling 100 Class 1 and 3 vehicles for a substantial $5.5 million between September and December 2024, which indicates some market traction.
All those positive factors signal forward momentum and potential for future expansion. The transition from development and promises to actual production, sales, and revenue generation is a critical step for any automotive startup.
But then we have the negative factors that are pulling that slope downwards, and these appear to be quite significant. The severe limitations in their cash reserves are a major red flag.
Huge red flag.
Along with the substantial ongoing losses and the high rate at which they are burning through their cash. Their very small market share in an intensely competitive landscape is another significant challenge. And we can't overlook the legal issues they're facing, the class action lawsuits that have been initiated by several law firms.
Right, the legal overhang.
Oh, hey, I think our listeners got something to say.
Hey guys, thanks for including me into this and letting me cut you through. Based on what we were just talking about on the legal proceedings, I've also provided an extra piece of detail on current Mullen court battles against stock manipulation. What can you kind of provide from that that might give an insight on the current trends?
Hey, thanks for chiming in and sharing that extra detail with us.
Absolutely. We really appreciate you bringing that to our attention.
Okay, let's unpack this. You're right, we were just discussing the financial headwinds Mullen is facing.
And this legal development you've pointed out is certainly a significant factor in their overall trajectory.
From what we're seeing here, the fact that the judge has denied the motion to dismiss is a pretty big win for Mullen.
It suggests that the court found their claims of stock manipulation to be substantial enough to proceed.
Here's where it gets really interesting. The article highlights the specific allegations.
The lawsuit claims these firms used high-frequency algorithmic trading.
Specifically, something called baiting orders to artificially lower their stock price.
Then they would buy at those deflated prices.
The court's acknowledgement that Mullen showed how these actions different from typical market behavior is key.
It validates that Mullen's concerns about potential stock manipulation have some merit in the eyes of the court.
So what does this all mean for the current trends? Well, this legal victory could have a few important impacts.
For one, it could potentially lead to a significant financial recovery for Mullen if they ultimately win the case or reach a settlement.
And as we were just discussing, they could certainly use that capital.
Precisely. It could provide a much-needed boost to their balance sheet.
Beyond the financial aspect, this ruling might also boost investor confidence, wouldn't you say?
It could signal to the market that Mullen is serious about protecting its shareholders and isn't afraid to take on major financial institutions.
It also sets a potential precedent for other smaller companies that might feel they've been similarly targeted.
This case moving forward into discovery will be fascinating to watch.
It could reveal a lot more about the alleged practices and the extent of any potential manipulation.
This definitely adds another layer to our analysis of Mullen's growth potential.
Okay, let's now pivot and look at where Mullen fits into the broader electric vehicle market. The data indicates they currently hold a relatively small market share, around 2.53%, within their specific commercial vehicle segment.
Specific segment.
Their presence in the overall EV market is even more minimal. That seems like a significant hurdle to overcome.
It is a significant hurdle. When you consider the dominant players in the EV arena, the Teslas, Chevrolets, Fords, Nissans, and the global giant BYD Mullen is operating in a highly competitive space.
Yeah.
Even within the commercial EV sector, they face established competitors like Orange EV and V.
Finally, their level of investment in technology, while strategic, is considerably less than that of the industry giants.
These negative factors underscore the very real risks and uncertainties that Mullen faces. The precarious financial situation is particularly concerning, as it could severely limit their ability to scale up production, invest in future technological advancements, and even sustain their current operations.
So, when we look at the strengths and weaknesses outlined in the reports, it paints a fairly clear and somewhat concerning picture. On the positive side, their strategic focus on the commercial EV market, the revenue growth that they've managed to achieve, their increasingly diverse range of commercial vehicles.
The Bollinger acquisition helped there.
Their possession of multiple production facilities and the fact that they have manufacturing operations based in the U.S. are all notable advantages. Additionally, they are reportedly in compliance with regulations, maintain a stable gross profit margin, potentially have a first mover advantage in certain niche commercial segments, and fundamentally have demonstrated the ability to sell their electric vehicles.
These strengths provide a crucial foundation upon which Mullen can attempt to build. Their focus on the commercial EV sector allows for a more targeted approach, and their U.S.-based manufacturing could offer advantages in terms of government incentives and supply chain resilience.
However, the list of weaknesses is substantial and concerning. The critical financial constraints with their rapidly dwindling cash reserves, the continuing significant losses and high cash burn rate, their current very small market share,
Yeah.
the ongoing legal challenges that could have financial and reputational consequences, and the technology gap resulting from their limited R&D spending compared to competitors. They also face challenges with limited brand recognition, the need to significantly increase their production scale, and what's described as a business model that has yet to be truly proven in the long term.
Indeed. Addressing and overcoming these weaknesses will be absolutely vital for Mullen's long-term survival and its ability to achieve sustainable growth. The financial situation is paramount. They must find effective ways to significantly improve their cash flow and drastically reduce their substantial ongoing losses.
Looking towards the future outlook, the reports emphasize that Mullen is at a truly critical juncture. Several key factors will determine their long-term viability. Securing significant additional funding and drastically reducing their cash burn are absolutely essential.
Absolutely critical.
They must successfully execute their strategy in the commercial vehicle market, meeting their production targets and securing substantial fleet orders. They also need to find ways to differentiate themselves in the increasingly competitive commercial EV space and effectively navigate the constantly evolving regulatory landscape. Strategic partnerships could also play a crucial role. Their stated goals include delivering over 3,000 vehicles and securing a significant $250 million in committed capital.
Achieving those stated goals of 3,000 vehicle deliveries and securing $250 million in committed capital within a defined time frame would serve as a very concrete indicator of progress and a significant step towards demonstrating both their production capabilities and their financial viability. It directly addresses two of their most pressing challenges.
So, the overall picture seems to be that this moderate positive growth trajectory, that slope of 0.45, suggests that Mullen has the potential for future success, but only on the condition that they can effectively address their very serious financial challenges and successfully execute their strategy within the commercial electric vehicle market.
Right, it's a big if.
There are still very significant risks and uncertainties that remain.
But that's a very accurate and balanced summary. The 0.45 growth trajectory reflects that delicate and precarious balance between promising developments and very considerable ongoing challenges. It's not indicative of a guaranteed success, but it also doesn't suggest an immediate failure, at least not based on the information we have today.
So as we wrap up this deep dive, we've seen that Mullen has demonstrated impressive revenue growth and made a strategic and arguably smart pivot towards the commercial EV market. They have a growing portfolio of commercial vehicles and are making investments in their production capabilities. However, they are currently facing significant financial headwinds, including rapidly decreasing cash reserves and substantial ongoing financial losses, all within a highly competitive industry. That growth trajectory slope of 0.45 really encapsulates this complex interplay of potential and peril.
Precisely. The data paints a picture of a company at a crucial turning point. The decisions they make and the results they achieve in the next year or two will likely be decisive in determining their long-term fate.
And that brings us to our final thought for you, our listener. Considering the significant financial obstacles that Mullen Automotive is currently facing, what single factor do you believe will be the most critical in determining whether they can truly capitalize on the expanding commercial EV market? Will it be their progress in developing and commercializing their solid-state battery technology?
The big tech bet.
Or their ability to secure those large, stable fleet orders that could provide a much-needed, consistent revenue stream? Or perhaps some other factor entirely? It's a complex situation with many interconnected challenges, and we encourage you to really consider all the different angles. Thanks for joining us for this deep dive.